A hard statistic often clarifies the future better than any story. One recent analysis from a major consulting firm projected that up to 40% of all hours worked in the banking sector could be impacted by generative AI technologies alone. This is not a distant, abstract idea. It is a concrete forecast for a shift that is already beginning. The financial world, an industry built on data speed precision, stands at the brink of a profound transformation driven by artificial intelligence. This is a very big change. Think of it less as a simple upgrade and more like the invention of the internet, mobile phone. It will reshape how money moves, how decisions are made, how people interact with financial institutions. The impact of AI will not be uniform across the financial industry. It will touch different roles in very different ways. The jobs most susceptible to change are those characterized by routine, repetition, data processing. Consider the bank teller. For decades, they were the primary human face of a bank. Many core tasks like processing deposits, withdrawals are already being automated by ATMs and mobile apps. AI will accelerate this trend, handling more complex queries and transactions digitally. This does not mean the role will vanish entirely, but it will transform into one focused on complex customer relationship issues that require empathy and problem solving. Financial analysts, especially junior levels, will see a dramatic shift. A significant portion of an analyst's time is spent on gathering, cleaning, organizing data from financial statements, news reports, and market feeds. These are tasks at which AI excels. An AI tool can perform this work in minutes, a task that might take a human analyst days. This will free analysts to focus on higher value activities: interpreting AI model outputs, questioning assumptions, developing creative strategies based on insights. Traders in high-frequency and algorithmic trading are already living in an AI-driven world. This will expand to other areas. AI models can monitor markets 24 hours a day, identifying arbitrage opportunities and risk exposures far faster than any human team. The human trader role evolves from rapid execution to strategic oversight and intervention during unexpected market events. Risk managers and compliance officers will be augmented, not replaced, by AI. To understand the future, we must first understand how the work itself will change. The impact of AI can be broken down into three fundamental areas: automation, prediction, interaction. Automation is the most straightforward, teaching machines to perform structured, repetitive tasks. Data entry, reconciling accounts, generating standard reports, processing loan applications that fit simple criteria. By offloading this work to AI, institutions reduce errors, lower operational costs, and free humans for complex duties. Prediction is transformative. AI finds subtle patterns in historical data to forecast outcomes: credit risk, market moves, customer churn. It can weigh spending habits, income stability, and macroeconomic trends to assess loan default likelihood. Interaction redefines communication. AI chat and voice handle common inquiries instantly, 24/7. They can answer balance questions, reset passwords, and provide basic guidance, freeing humans for sensitive, high-value cases. Imagine a mortgage application process. Today, it involves a lot of manual paperwork and checks. In the future, an AI automates data collection from various sources. A predictive model instantly assesses risk and offers a preliminary decision. A chatbot guides the customer and answers questions end to end. A human steps in for complex cases and final review. The advisor, not the processor. The future we are describing is not purely theoretical. The seeds have been planted and are growing rapidly. Many of us are already interacting with AI in our financial lives, perhaps without realizing it. Robo-advisors provide automated investment management. You set goals and risk tolerance. Algorithms build and manage a diversified portfolio at a fraction of traditional cost. AI keeps the system secure. Every card swipe is analyzed in real time against patterns, location, and context to assess fraud probability. Suspicious transactions can be blocked instantly, saving consumers and banks billions each year. AI loan scoring uses broader data, rent, utilities, education, to build a holistic picture and expand access for the historically underbanked. In trading, ML strategies now learn from satellite imagery and social sentiment, shifting to a hybrid model. Humans set strategy. AI executes at scale. These systems constantly learn and adapt based on new information. For major life events and complex planning, human advisors remain essential for empathy, creativity, and judgment. That's the arc analysts are laying out as we head into that next decade. Looking ahead to 2030, analysts are outlining a timeline. The next 5 to 7 years will see rapid adoption. Today's tools are narrow. By 2030, expect integrated systems that reshape entire workflows. Changes roll out in phases, starting with routine, data-heavy functions, then moving to complex areas. By 2026 to 2027, most back-office functions will be widely automated. Compliance checks, trade settlements, and financial accounting are early beneficiaries. Expect significant cost reductions and sharp gains in efficiency and accuracy. Work shifts from doing to supervising AI systems, demanding data literacy and system oversight. Approaching 2030, emphasis moves to decision support. AI becomes a standard assistant for portfolio managers and risk analysts. It delivers real-time insights, flags risks, and suggests strategic options, with humans firmly in control. New hybrid roles emerge, blending human expertise and machine intelligence for superior outcomes. Customer experience is reimagined. Proactive nudges, personalized budgets, better products, and conversational interfaces for everyday needs. The push to integrate AI is driven by powerful benefits, starting with speed and efficiency. Processes that take days, like underwriting complex commercial loans, can compress into hours or minutes. AI can process and verify documents, analyze risk factors, and generate reports at a velocity no human team can match. Speed translates to lower costs, freeing capital and talent for innovation and growth. AI can provide more consistent analysis than tired, biased, or emotional human decision-making, when well designed. Models examine thousands of data points, uncovering correlations humans might miss, improving risk management and outcomes. AI-powered mobile banking lowers service costs and can extend credit and insurance to remote or low-income communities. Hyper-personalization becomes mainstream, a true financial coach that's tailored to your history, goals, and life events. Service levels once reserved for the ultra-wealthy could be available to everyone. While the promise is immense, we must face the risks clearly, starting with job displacement. As automation expands, routine functions will shrink or disappear, creating disruption without reskilling. A coordinated effort among companies, governments, and educators is essential to retrain and upskill. Algorithmic bias is a profound risk. If trained on biased history, AI will learn and even amplify that bias. Ensuring fairness requires careful data selection, rigorous testing, and ongoing auditing. Explainability matters in finance. Decisions must be traceable, whether a denied loan or a trading error. Interconnected AI creates systemic risks, algorithm flaws, cyber attacks, and power concentration. Resilience demands security, redundancy, and regulatory oversight. We must balance innovation with safeguards. Navigating the AI revolution requires deliberate strategy. First, massive reskilling and upskilling, shifting from routine processing to judgment, creativity, and collaboration with AI. Teach data literacy and analytical skills, and the ability to critically evaluate AI outputs. Design for human-AI collaboration, not just automation. AI lifts heavy data work. Humans make final calls. Establish rigorous testing, auditing, and governance frameworks for accuracy, robustness, and fairness. Run pilots in well-defined areas, learn, de-risk, and scale. Prioritize data security and privacy at every step. These are fundamental requirements. By 2030, AI can make finance faster, more efficient, robust, responsive, and inclusive, if we steer it wisely. Pursue innovation with clear guardrails on fairness, transparency, and accountability, without stifling progress. Institutions. Build reskilling and ethical AI governance now. Employees. Embrace lifelong learning. Policymakers. Enable responsible innovation. Let us be the architects of this future, not merely spectators.